The biggest mistake that unprofitable traders keep doing throughout years is not understanding the core logic of the markets. Not knowing how does the markets operate is costing you thousands of dollars, dozens of funding challenges failed, and hundreds of strategies changed. But in reality, if you stick till the end of this video, no matter what strategy you trade, no matter what type of trader you are, a day trader, swing trader, or even a scalper, you will have the breakthrough in trading, that exact aha moment that you were looking for. Today, we're going to cover two core market conditions that dictates what you have to trade, and we are going to cover three more entry models that you must incorporate into your trading plan that will help you to adopt and trade all the market conditions. But this is not all, folks. At the end of this video, I will let you know the exact way of how you can trade any strategy and make it a mechanical and rule-based. Hello folks, welcome back to OP Investing. My name is Islam. This is a second episode of the 4-part mini-series where I will take you through the exact blueprint that will help you to master a mechanical edge over the markets to scale your trading to 6 or even 7 figures in the next 30 days without guessing your trades or being glued to the charts. If you haven't checked the first video, I would highly suggest you to watch that first and get a full picture of what we're talking about here. Without wasting your time, let's get started. Let's first start with the basics of trading. Understanding this is important, yet most traders don't pay attention to it. There are two core stages in the markets. Let's quickly break them down, how you can effectively identify these stages, and then I will explain why it is important and how we can use it. Markets are either trending up or down, or the price is moving sideways. Let me quickly explain how we actually know when the price is trending and ranging. This is going to be a quick lesson on how to read the market structure. When the price is creating highs that are higher than the previous ones and lows that are higher than the previous lows, that means that price is in an uptrend. When the price is creating lows that are lower than the previous lows and the highs that are lower than the previous ones, that means we are in a downtrend. All of that should happen consistently. The price keeps making new highs and lows in one direction. Then we can tell that the price is either trending up or down. Now let's break some real charts. Over here you can see a clear downtrend to the downside. This is a EUR/USD on the daily time frame, and you can see here we do have the lows that are the lower than the previous lows, and we do have the highs that are lower than the previous highs. That means that we are in a downtrend. The biggest criteria of the trend is that the price is making consistent actions, consistent impulses in one direction, whether that's going to be up or down. Over here you can see it's the price going from the downtrend over here going into the uptrend. It starts making consistent highs that are higher than the previous highs, and it starts making consistent lows that are higher than the previous lows. Now that you understand what a trending market is, it is crucial to understand what is a rangy market is. A rangy market is literally the opposite of the trendy market. If I had to break it down in one sentence, price is not making consistent highs or lows in one direction. The price might make a higher high only to make a lower low right after that. Sometimes price makes a new highs and lows and then just sweeps the previous levels and then reverses. Now let's look at how this plays out in the real market conditions. Over here you can see a clear rangy market conditions on the EUR/USD. The price is just going sideways, making high, it's making low, it's making higher highs, it's making higher low, higher high, but only after that the price is just crushing to the downside, making the lower low, and after that it's going to the upside, making a lower high and then higher low, and then we are making another higher high. So it's basically going in a sideways. We don't have any consistency to the upside or to the downside. Of course, if we zoom in into the lower time frames, we will be having its own like lower time frame trends, but on the daily time frame we can see a clear range bound market conditions. This is how it looks on the real market conditions. Now, that's why how we identify the markets using the market structure. But here's another way to do that using the 200 EMA. This method is widely used by the institutions and banks. The 200 EMA is literally the key to identifying the long-term trends in the markets. It's simple. When the price is above 200 EMA and the EMA itself is sloping to the upward, we are in an uptrend. When the price is below the 200 EMA and the EMA itself is sloping to the downward, we are in a downtrend. Personally, I don't use it to identify the trends, but rather I use this to identify the absence of the trend. And for that, it works perfectly fine. When the 200 EMA goes flat, that means that we are in a true rangy market conditions. So now we know how to identify both trendy and the rangy market conditions using market structure and the moving averages. But why is this so important? Most of the traders fail or go through the losing streaks not because they have a bad strategy, but because they use the wrong strategy for the current market stage. Think about it. Can you use the trend following strategy in the rangy markets? Or can you use the range trading strategy in the trendy markets? The answer is no. For each market conditions, you must have a strategy that fits it. Based on what we have covered so far, you must have at least two strategies. One for the trendy market conditions and one for the rangy market conditions. Alright, now let's talk about the three core entry models that will literally catch all the possible market conditions. The first one is the breakout model. But before we dive in, think about this. As you remember, we have two market conditions, when the price is trending and when the price is ranging. After the trend, there is always going to be a range. After the range, there is always going to be a trend. A range cannot last forever. After some accumulation, the price will break out and start the new trend. And the trend can't last forever either. Eventually, it will exhaust and transition into the rangy market conditions. So the logic behind the breakout model is that we catch the trend even before it is born. I bet you've been in a situation when you see a clear trend, you try to jump in and the price immediately reverses against you. Let me tell you something. If you can see a clear trend, it is already too late. Too late to trade it. This is a very famous 5-wave pattern that was invented by the Ralph Elliott. He said, overall the trend in the markets consists of the 5 waves. 3 waves in the direction of the trend and 2 into the opposite direction. After price completes these waves, there comes a short-term correction or the sideways movement. But we are not here to learn about the Elliott wave analysis. I'm giving this example to explain you when you see price having a consistent trend, the end of the trend might be somewhere near. So the best way to identify the trend, actually trade it, it would be when it's about to start. 90% of the traders fail. And if you want to be among the 10% of winner traders who actually win and move the markets, you need to spot potential trends before they even happen. That's why the breakout model, instead of looking for the trends, we focus on spotting the rangy markets, because that's where the next big movement is going to start. So literally you can use this model in any time frame, and adding this model into your trading routine will dramatically improve your win rate. Now let's move to the second universal model, trading the reversal. This is basically about trading the supply and demand zones. This method works best in the trendy market conditions. As you know, when we are riding a trend, you have to wait for the price to pull back and then catch the reversal in the direction of the trends from the key supply and demand zones. But let me share a little secret about the supply and demand zones that will change everything for you. You need to stop looking for the random swing highs and swing lows and start focusing on the supply and demand levels with a time reference. Here's how it's done. If you're a day trader or scalper, you should only look for the supply and demand levels inside of the previous day candle. Just get the previous day candle and look for the supply and demand zones only inside of the previous day candle. The price action happened during the previous day candle is all that matters, nothing more. Let's say you're a swing trader. You need to look for supply and demand levels inside of the previous week's candle. That's where you will find the key levels with the power to move the price for the upcoming week. All the rest levels are just some fake imaginary levels. Probably they will never get mitigated at the first place, and secondly, just forget about them. Following this rule, you don't have to guess which supply and demand levels you have to choose among millions of levels on the charts. Let's say you're a day trader and you look for supply and demand levels inside of the previous day candle. There are going to be only a handful of levels that you can choose. So this will reduce the level of stress that comes from the abundance of choices. There's going to be just 2 or 3 maybe levels inside of the previous day candle. Furthermore, you will stop choosing the levels that are super far away from the current price, so you don't waste your time for the levels that are never going to be mitigated. Once you start following this, you will see a tremendous change in your trading, and sometimes you can even trade range-bound market conditions when the price reverses from the established highs and the lows. Now, the last pattern that you have to incorporate into your trading plan is liquidity grab model. This is where the price sweeps previous highs and lows and makes the fake breakouts before reversing into the opposite direction. Let's break down how liquidity grabs and fake outs look like. A liquidity grab happens when the price wicks above or below of the given high or low. A fake out occurs when the price breaks out with a strong bullish or bearish candle, but the very next candle reverses back inside of the level. Now, you probably already know about the liquidity grabs and fake outs, and that you should trade them during the rangy markets when the price is sweeping highs and lows without clearly trending in one direction. But let me tell you something, using random highs and lows will not work if you want to catch perfect liquidity grabs. To do it perfectly, you need to know exactly where liquidity is resting. In just a minute, I will show you the exact mechanical and effective way to identify liquidity zones. But first, let's talk about where not to look for liquidity. Forget about the equal highs, trend lines, or other BS levels. They are not mechanical. The levels you see will be different from what someone else sees. One trader might mark equal highs in one place, while another will draw trend lines differently. It is completely subjective. Syncing up 2 random dots on the charts, it is insanity. Your liquidity levels should be so mechanical that even your grandma could find them. So what's a real way of identifying the key liquidity levels? Looking for the highs and the lows that are tied to the time. Previous day high or low, previous week high or low, previous month's high or low. These are the most mechanical, universal, and the strongest liquidity levels. They will be the same for you, for me, and for anyone else in the markets because they are absolute. We're not just taking them out of our mind. We're not just spotting them, looking for them. They're absolute. Using these liquidity levels, you will stop guessing where the real liquidity is resting. Your trading process will require less mental resources, so there will be a less chance that you will start taking impulsive trades. To sum it up, if you're trading the markets every day using the breakout, reversal, and liquidity grab models, you will be able to cover almost 90% of the price action. You will be able to trade both trending and ranging market conditions. You will be able to catch reversal as well as the start of the new trends. Now, I would say probably you're already using these models, but in the wrong way. Maybe you're focused only on one of them, when in reality you need to master all of them to get the best results. Maybe you don't have a complete trading plan and systems around these entry models, because remember, these are just tools. Without a proper plan, they will not make you any dime. Like, you will not be a profitable trader. You need a system. And most importantly, I bet you're using them in a non-mechanical way, spotting random supply and demand levels, drawing equal highs or trend lines for liquidity, or trying to catch random breakouts. That won't make you a consistently profitable trader. We have already discussed some key elements to help you trade these models in more mechanical way. Personally, I have developed 4 patterns based on these 3 core entry models that occur over and over again during the London and New York sessions. These are called OP investing methods. And because they are 100% mechanical, even your grandma could trade them. In the next video, we are going to break them down one by one with actionable steps. See you there.